Thank you. Okay, so thank you. Great to be here. I've flown over from London to speak to you, and it's delightful to be here. It's such a famous event, Bitcoin Wednesday. Richard's done such a great job to create this event, and I've been a huge admirer of it, and I was very honored to be asked to speak. I've been in the community in London for almost 5 years. Done a lot of meetups there. I backed a few startups. I had a startup called Bullion Bitcoin, which is a gold to Bitcoin exchange in 2013. I think I was a bit early, unfortunately. Since the middle of this year, as the ICO boom sort of took off with some colleagues, we formed a partnership called Novasset, New Asset. Could have chosen a better name, but you know. And our partnership is about basically doing corporate finance role, trying to help tokens structure themselves in a compliant way, because there are so many tokens coming to market, and we've helped a number of them come to market. And we have a number of current mandates. One you may have heard of is called spicevc.com. So we are helping tokens to come to market and structure themselves in accordance with the regulations. So tonight I'm going to talk about security tokens, and the reason that I'm focusing it down on security tokens is because there are so many utility tokens, and my experience with utility tokens has been that, frankly, at least for the advisors, they're incredibly dangerous because there are so many possible obstacles and problems that arise from issuing a utility token. So as a result of our partnership and the fact that we also own a regulated entity in the UK, which enables us to promote securities, we are focusing on security tokens. So to jump right in, this is the sort of division that we've come up with now. It's not really a legal division. It's not really very accurate legally, but broadly we have digital currencies, which you all know what they are, Bitcoin, etc. We have utility tokens, which essentially is access to a service, like paid API keys. You put money in and you get a decentralized computing cycle out. You put money in and you get a decentralized storage thing. And you know, it shouldn't be any return. And we have security tokens, which is what I'm going to focus on, which are tokens where they are considered a common enterprise for profit, where the primary aim is to create a profitable enterprise that yields a return. So I think a lot of people will say, well, this is a revolution. You know, we're doing things differently. We're going to ignore all that stuff. And I have a lot of sympathy with it. But I don't have a lot of sympathy with going to jail, or with any promoter going to jail. And unfortunately, a lot of the things that are issued prima facie are securities straight off the bat. And even as much as you try to contort the rules and say it's not a security because of this or that or the other, it is a security. By and large, it is a security, because the definition of security is very broad. Most importantly, in the US. And why is the US most important? Because it's the only country that is willing to engage in extraterritorial enforcement. The US recognizes no borders. The US is everywhere. The US will come and arrest you here, in London, wherever. We even have a wonderful act called the Extradition Act, which allows the US to come and arrest anyone in the UK without even asking, right? So the US will do extraterritorial enforcement, and that's why it's important for you to know what the definition of a security is in the US if you are doing an ICO. Most tokens that I see that are presented to me really imply an expectation of some profit of some kind, of a return of some kind. And in that case, although they can be utilities, they're more safely expressed as a security. It's safer to say, actually, we'll call this a security because that way we won't have any problems, we won't go to jail. And the difficulty is always this idea of retrospective action, because it doesn't matter that it was done 2 years ago, it can always come back to haunt you. As in, one of the largest is Tezos, which is now beset with legal and regulatory problems. So the test of when something is or isn't a security, at least in Anglo-Saxon jurisdictions, which is the ones I'm familiar with, is this idea of substance over form. So, as I say, there's no point in saying, oh, well, it's not a security because we've done it differently, or because it refers to something, a new innovation, or something like that. If it looks like a security, it probably is a security. If it gives a right to a profit, it is a security. If it gives voting rights, it is a security. If it's an option, if it gives a return in any way, it is a security. I've touched on this already, and I think what I'll say from this is that if you are doing a token, any project that touches the US in any way, even the most tangential way, even having a server there, anything that touches the US, they can take jurisdiction from that link. So be careful if you're doing a token and you're on the margins of respectability. Be careful about any links with the United States, because they will have it recorded, and when they want to, they will come back and say, you sent an email promoting a security in 2016, you are violating this law. Be careful, is what I would say on that. The other point to make is that any project that is not fully functional, does not have a running version with users, working, etc., is a security in the US. So be careful if you are not fully functional. A few wandering into US securities law, we have this famous Howey test, which is basically quite useful to just focus down on it. What is a security? It's a security if it's an investment of money, if there's an expectation of profit, however vague, right? If it's invested in a common enterprise, which most tokens are, a common enterprise with a central issuer, and if the profit comes from the efforts of a promoter or third party. In other words, if it's not down to you doing some work, which is why StoreJ works and Sirecoin works, because you're doing the work, participating in the network. But if you're not doing the work, if the effort comes from a team, then it is a security. The second test, which less people talk about, is something called the risk capital test. And this is a test in a number of US states. So, for example, in Washington, a security is an investment of money or other consideration, anything, Bitcoin, Ether, whatever, right? In the risk capital of a venture, very widely defined, risk capital can be anything, with the expectation of some valuable benefit, not even profit, some benefit, right? Where the investor does not have the right to exercise control over the venture. So, honestly, almost all tokens is perhaps a bit of an overstatement, but almost all tokens will fail in some way on this definition. In the US, you have a range of other lovely laws to fall into as a trap. Money transmission laws, state securities laws. You don't have to comply with one law. There's no overarching rules. There are rules in every different state, and they all do different stuff, right? Or you can be classified as a commodity. There is, however, in the US, some good news. The good news is that by issuing bulletins and guidance, effectively the SEC is recognizing that if blockchain assets can be securities, then all securities can be tokens. So we can, when we establish a regime, when we find a way forward, then we can look forward to tokenizing everything, all sorts of contractual rights, all sorts of property, and we don't have to stick with existing definitions, existing structures like stockholder companies or bonds. Globally, when you're issuing a token, you have to bear in mind a number of things, leaving aside the US, globally. KYC and AML is what everyone knows about and everyone focuses on. but fewer people focus on what's called financial promotion. So if you are selling something that is considered a security, there are financial promotion rules. You cannot promote a security unless you are authorized to do so. So financial promotion is something to bear in mind. Selling restrictions. Most of these things should only be sold to professional or accredited investors, and the definitions change country by country, and so require, if you're going to do it right, they require quite specific legal advice. Prospectus. If you issue beyond a certain amount, more than 5 million euros, you probably need to issue a prospectus. And the prospectus directive is quite onerous in the EU, for example. And the sort of one of the key restrictions is restrictions on secondary transfer. The reason that most tokens take place in 1 or 2 jurisdictions is because in most jurisdictions you cannot transfer in the secondary market the tokens without requiring customer due diligence and AML on every single transfer. So prior to sending something, you know, on Ether, pressing the wallet and sending the token from here to there, you should be doing customer due diligence on every single transfer. Other considerations, whether you're a collective investment scheme. And being a collective investment scheme just means that you say, I'm going to decide what we all invest in, and then give the rewards to the token holders. That is a collective investment scheme, which brings on a whole new range of regulation. FATCA and CRS, which is the global tax reporting standard that has been introduced essentially this year, which means that basically all transactions in fiat, all banking transactions are all under surveillance, monitored, reported back to the tax authorities. And issuers have a responsibility to take all transactions in their security, as do banks, and report them globally. So they have this global database where they can surveil everything we're doing, you know, hence Bitcoin.
That's possibly modified by the Tax Act that's in Congress right now. The Tax Act in Congress now is going to make the U.S. a territorial tax jurisdiction. So watch out for that.
Thank you. That's helpful. Appreciate that. What he said was that the Tax Act in Congress now is going to change that. So, and I'm sure that's true. And everything I'm saying is not legal advice, because I'm not a lawyer, thankfully. But also, everything I'm saying changes constantly, basically. Every time I go to a different lawyer in a different jurisdiction, the rules change constantly, and it's a constant moving kaleidoscope of rules that you're constantly having to adjust to. Other things that may apply: consumer protection legislation, privacy, intellectual property. These are all things that token holders sort of have to consider. The key challenge which we're sort of working on, trying to solve, is acceptance of the fundamental nature of tokens. So basically, tokens for me are open, permissionless, and decentralized. They should open up sort of the investment horizon to a whole new range, a sort of a global audience. And by definition, they need to be transferred in the secondary market, transferable in the secondary market without friction. But very few jurisdictions are willing to accept this. So this does sort of require specific regulatory innovation from a jurisdiction, which is what we're always working on. I think what I'm looking to now say is that why should we have security tokens? Why isn't the existing system good enough? I think, you know, why security tokens will help us is these reasons. Liquidity alone should allow for much greater capital allocation and efficiency, because at the moment everything sort of works in a walled garden, in a silo, and everything is inside a sort of club, and the liquidity therefore outside of the largest assets in the world is actually extremely low and extremely limited. So I think tokens can help resolve this. Network effects, so you have a much wider and broader network of people who can look at a vast range of investments. In many jurisdictions, outside of a limited number at the top, the range of investable options is extremely limited. So the idea is that tokens will allow us to broaden out the range of investable options greatly. Hopefully lower cost, fewer barriers to entry, and free transferability, which I referred to before. I've spoken about liquidity. This is my point about walled gardens, is that securities issues today are always in this walled garden, in these clubs. And, you know, it's like Hotel California. You can check out, but you can never leave. And, you know, there's just no transferability and no movement and no capital outside of these closed clubs. And I think that potentially, if we can find a regulatory framework and innovation that works, tokens should enable instant custody without intermediaries. At the moment, we have all these intermediaries who gladly collect your assets into these walled gardens and say, we'll take care of these for you, please allow us to take care of these, we'll charge you an annual fee, and they sort of sit on them. They call it sticky money, right? But tokens should allow us all greater freedom and personalization in terms of holding a larger range of investable assets, which is what I've just said there. Here are some security tokens. Security tokens still quite limited because of the constraints, rules, regulations, restrictions that I referred to earlier. It's quite expensive to do a security token at the moment. So the first security token really is blockchain capital, which went on in April this year by Brock Pierce. Currently we're doing Spice Venture Capital, which is a tokenized venture capital fund. There's Science, which is a sort of incubator fund, again. Protos, which is a cryptocurrency sort of hedge fund, which has just finished pre-sale. And then other people are doing equity tokens in, again, different jurisdictions, which I must confess, I know more about Anglo-Saxon type jurisdictions than I do about Swiss and German jurisdictions, so forgive me. But Liquid, Switzerland, Neufund is doing an ICBM at the moment, not to be confused with an intercontinental ballistic missile. And so that's in Germany, which is effectively a sort of platform for other equities to be listed on, like a crowdfunding with a token. And Bitwala in Germany is doing a token. So there are security tokens being issued, but at the moment there are considerable challenges to them being issued because of the legal and regulatory obstacles that I referred to earlier. Just as a specific example, we have Spice Venture Capital, which is the issue we're currently doing. It's a tokenized venture capital fund, investing, you know, in things that funds normally invest in. And effectively, the token gives you a contractual rights to the exits from the investments. We've registered in the US. We're sponsored and approved in the UK and the EEA. Cavenham Capital is our sister company. And so this is the sort of structure you need to assemble to be able to sell a security token in the US, the UK, the EEA legally, which is what we've tried to achieve. Going forward, I mean, what I see is either tokens will sort of double down on anonymity, forgive me, and we will have decentralized exchanges, decentralized private currencies, decentralized issuers, and effectively tokens will take place completely in the ether if the security apparatus proves to be too burdensome to allow this to happen. So I think this will happen, right? But what I also expect is that on the other side there will be a sort of fully regulated pathway, which we're starting to see the emergence of, and what we are working towards ourselves in our jurisdiction. And in the US, you see things like CoinList, the agreement on future tokens, and what we need to overcome the secondary transferability on the regulated side is a sort of regulated exchanges. And so the one that's most commonly cited is T0 in the US, but we need others to up the status of their regulation so that they can trade tokens, security tokens. So that's it. You can contact me here on Twitter, and thank you very much.
So, thank you very much. Oh, thank you very much, Adam. So if anyone has some questions, I will throw this box to you. I can't see here. Are there any questions?
There's one right at the back and one
One
there.
right at the back. Okay, does this work actually? Yes?
Hi. Thanks for the presentation. There's one criterion in the Howey test that says efforts of a third party or the promoter. Now, for example, in the case of the DAO in theory was a collective venture. I mean, anyone buying in would be involved in decision making and management, yet the SEC actually ignored that argument. I mean, do you have examples of cases where people were able to successfully prove that it was a collective enterprise and not that you didn't depend on effort of a third party? And do you think that if the SEC case would have gone to the bottom, because now they created the precedent and no one wanted to challenge it because they got free, and if they were to challenge it, they actually ran a risk. So what's your opinion on this?
I'm not sure I agree with the SEC, but who am I to disagree with them? As I say, they make their own rules, they change them when they feel like, and they come and get whoever they don't like, more or less. And so I think we don't really have any cases. A lot of it is done in a way that perpetuates the ambiguity and essentially tries to ensure that it's kept outside of the system or to the margins of the system. And the FCA follows, in the UK, follows a very similar policy where they issue guidance sort of saying, tokens are very dangerous, but we're not going to regulate them, because if we did, we would give them credibility. And that would be bad, because we don't want them to have credibility, because we have a massive securities issuance industry that does not really welcome competition and new models and innovation. So unfortunately, in the US and the UK, I would expect regulatory ambiguity to persist and for them to try and keep the model at bay for as long as possible, in the same way that like they leave gold and Bitcoin out of the investable universe by sort of saying it's not an investment, we're not going to regulate it, so they don't confer the legitimacy on it. And this is a deliberate policy, I'm afraid. So.
How are you sure that Bitcoin isn't a bubble, or maybe is a bubble?
I mean, you know, last week on Wednesday, I gave a talk in London about Bitcoin to some wealthy people, but who didn't understand it and at all. And my goodness, they were hostile. I mean, they just so hated it, especially when I got into the politics of it, and especially when I had that question. And my answer to is Bitcoin a bubble is everything's a bubble. The whole system's a bubble. The system's been a bubble, you know, building a bubble since 1971. You look at any chart of debt, any chart of the Federal Reserve balance sheet, any chart of student debt, any chart of the stock market, total credit market debt as a percentage of GDP, everything is a bubble, right? So the system is the bubble. It's not Bitcoin that's the bubble. The system is the bubble. And Bitcoin is effectively acting in a role of, you know, giving the temperature of the system. So the fact that people are looking at the current system saying, God, this isn't a very good system, this looks quite unstable, I know what, we'll go into Bitcoin. That's what I think is happening to a great extent. And yes, there is speculation, and yes, there is some speculation, but I think it's adoption rather than a bubble. And it's just a function of Bitcoin's scarcity that we are where we are in terms of the price. So that's my answer.
Okay, thank you.
Anyone else? No? We're good?
Yeah, we're good.
Great.
Yeah.
Thank you.
So,